Hey guys, it's Christina from Our Rich Journey, and in today's video, I am going to be discussing the difference between a traditional IRA and a Roth IRA. And I'm also going to be giving you some things to think about in terms of your unique situation and which account may be better for you to invest in as you're pursuing financial independence. And then I'm also going to be talking about which account Aman and I prioritize on our road to financial independence, and I'll explain the reasoning why. Now, before I get started with this video, if you are new to our channel is all about making, saving, and investing money on the road to financial independence. Aman and I reached financial independence after 8 years. We quit our jobs and retired here in Portugal. So if you are interested in learning more ways to make, save, and invest money, make sure that you subscribe to our channel. So let's get started by talking about the traditional IRA. This is a traditional individual retirement account. Now, when you contribute to this type of account, you're using pre-tax dollars, which means that this type of account can help to reduce your taxable income for the year. Now, the money in a traditional IRA will grow tax deferred, meaning that while it's in your traditional IRA, you're not paying taxes on it. But once you retire and you start withdrawing money from your traditional IRA, that's when you're going to be paying taxes on the money that you withdraw. Now, a Roth IRA is different because you're using after-tax dollars to contribute to this type of account. This means that you won't get the upfront tax deductions on your contributions to a Roth IRA, but with a Roth IRA, you can have tax-free withdrawals during retirement as long as you meet certain requirements. So those are the basics between a traditional IRA and a Roth IRA, but I want to compare the two different types of accounts based off of different factors. So I'm going to start off with the tax treatment of a traditional IRA versus a Roth IRA. So in terms of tax benefits, with these IRAs, you're either getting them at the beginning when you make your contributions to an account, or you're getting them at the end when you're pulling out the money tax-free. The traditional Roth IRA gives you that upfront tax deduction in the beginning. And with a Roth IRA, you're getting the tax benefits at the end when you're withdrawing your money tax-free. So I want to talk more about withdrawing money from your traditional IRA versus your Roth IRA. And I'll start with a Roth IRA because there's a distinction between your contributions into your Roth IRA and your earnings in a Roth IRA. With a Roth IRA and your contributions, you can pull that money out anytime, tax-free and penalty-free. Now, in order to pull out your earnings tax and penalty free from a Roth IRA, you have to be at least 59 and a half years old, and your Roth IRA account has to be at least 5 years old. Now, with a traditional IRA, there's no distinction between your contributions or your earnings. So in order to pull out money from your traditional IRA penalty-free, you need to be at least 59 and a half years old. But when you pull that money out, you still have to pay taxes. Now, if you try to pull your money out of your traditional IRA before you turn 59 and a half years old, you'll have to pay taxes, but you'll also have to pay a 10% penalty. Now, there are certain circumstances where you can avoid the penalty, like if you're a first-time home buyer or if you're paying for higher educational expenses that meet certain requirements. But in general, if you try and pull your money out early before 59 and a half years old in a traditional IRA, you're going to be hit with a 10% penalty. Now, another difference between Roth IRAs and traditional IRAs are income limits. Roth IRAs have income limits for eligibility. So in 2023, for example, if you're singled and your modified adjusted gross income is above $153,000, or if you're married filing jointly with a modified adjusted gross income above $228,000, you cannot contribute directly to a Roth IRA. Now, traditional IRAs don't have income limits for contributions, but they do have limits for deductibility if you or your spouse have access to a workplace retirement plan. Now, I will note that even though there are income limits for contributing directly to a Roth IRA, there is a workaround called the backdoor Roth. I won't go into the details on this video about that, but if you're interested in learning more, please leave a comment below and we can make a future video explaining the backdoor Roth in detail. And finally, the other difference between these two types of accounts are required minimum distributions, RMDs. Traditional IRAs have RMDs, meaning that once you hit 73 or 75 years old, depending on the year that you're born, you are required to begin pulling money from your traditional IRA, even if you don't need the money. Now, Roth IRAs do not have RMDs, meaning if you don't want to have to touch your money, you want it to continue to grow, you can do that with a Roth IRA. So now that you know these differences between the two types of accounts, I want to talk about how you can really decide which type of account may be better for you to invest in on your financial independence journey. And I'll start off with the rule of thumb. And under this rule of thumb, the idea is that if you expect to be in a higher tax bracket during retirement, a Roth IRA may be a more beneficial account for you to be investing in now. And the idea behind that is you'll pay taxes now at a lower rate, and you'll be able to withdraw your funds from your Roth IRA tax-free in retirement when you're in that higher tax bracket. Now, alternatively, under this rule of thumb, if you expect to be in a lower tax bracket in retirement, the suggestion is that a traditional IRA may be better for you to invest in now. And this is because of the idea that you could reap the tax benefits today when you're in a higher bracket and pay lower taxes in the future when you go to pull that money out because you'll be in a lower tax bracket. So that is the rule of thumb, but I will tell you on our financial independence journey, we're always very critical about rules of thumbs because we think that financial independence is a unique process and the rule of thumb may not necessarily always apply. So for us, we really decided to invest primarily in a Roth IRA versus a traditional IRA because of 4 reasons. The first reason is the tax scheme. So under this rule of thumb, you really have to understand the current tax bracket that you fall in, which is fairly easy, but you also have to predict the type of tax scheme that you may fall in when you're in retirement. And tax schemes can change very significantly. The tax brackets can change in the future, and you don't necessarily know where you may be falling in the future. So for us, it's really hard to use this rule of thumb where the future may be very ambiguous or tenuous, and you don't really know what could happen in terms of where you may fall in tax brackets in the future. The second reason is flexibility. When you're pursuing financial independence, and if your goal is to retire early, you typically need to access your retirement accounts much earlier than the traditional retirement age. With a Roth IRA, you have the flexibility in that you can actually access all of your contributions in your Roth IRA tax and penalty free. And we think this is a huge advantage for people, especially people that are pursuing financial independence to retire early. The third reason is peace of mind. Once you reach financial independence and you retire early, if you can eliminate any additional expenses in your early retirement, you have greater peace of mind. And taxes is one of those expenses. So if you can eliminate that need to pay that additional tax expense when you're in retirement, you just have greater peace of mind. You don't have to account for that additional tax payment. And I think it makes it a lot easier for people once they're in retirement and they're managing their finances. And finally, there's generational wealth. Like I said before, traditional IRAs have RMDs. You're going to have to start pulling from your traditional IRA at some point, even if you don't need the money to pay for expenses, even if you don't want to have to pull from that type of account. With a Roth IRA, there are no RMDs, which means you can allow your Roth IRA to continue to grow. You never have to touch it if you don't want to have to touch it. And that leaves more money in that type of account for you to pass on to the next generation. Now, another nice thing about generational wealth with the Roth IRA is that once you pass that money on to your beneficiary, the beneficiary can also pull money from that Roth IRA tax-free. Now, there may be distribution requirements for your beneficiary, or they may have to take that Roth IRA and transition it into their own type of IRA account. But again, with a Roth IRA, once you're growing that account, because there are no RMDs, it just leaves more opportunities for you to pass on a larger amount of money to your beneficiaries. So those are the 4 reasons why we tended to really go against the rule of thumb as we were pursuing financial independence. And now I will tell you that you can invest in both a traditional and a Roth IRA at the same time in the same year. Now, of course, you can only contribute up to the maximum annual limit across both IRAs. But if you want to take advantage of the unique benefits offered by a traditional IRA and a Roth IRA, you can invest in both of them in the same year. Now, in terms of the actual investments that you're you're going to be putting into your different accounts. That is the next step for you to explore, to research, and to discover. We have a ton of different investment videos on this channel, so check out the videos. And if you're interested in seeing the specific types of investments that we made on our financial independence journey, you should check out our stock market investing course. In that course, like I said, we go over all of the specific investments that we made on our FIRE journey, but we also share our investment plan with you, and we also have an investment plan for you to develop in the course. So if you're interested in learning more, I will leave a link in the description below, or you can also just go to ourrichjourney.com. Now for this video, if you enjoyed this video, if you want to learn more about saving, making, and investing money, make sure you give this video a thumbs up, subscribe to our channel, and join the journey.